Hello, my name is Clive and I'm a director at Peak Accountancy Training. We provide online courses that you can use to study towards your AAT exams at levels 2, 3 and 4. So if you are interested in our courses, finding out more about them, please do visit our website www.peakaccountancytraining.co.uk. Well, in this recording, I'm going to walk you through task 7 of the AAT sample or practice assessment 2 for the Principles of Costing exam. Now we can see the task is worth 20 marks in total, and the task is focused in on budgeting and variance analysis. So to start with, we have to complete a statement about the use of budget. So let's try and remember what a budget is. A budget is a quantified plan of the future, and it helps a business to identify the resources that it's going to need to meet customer demand. It gives the business an idea of how much it's likely to sell, how much profit it's likely to make, and it's a control at the end of the day that helps the business and the managers within the business to control the performance of the business and keep within budgeted expenditure levels. So let's have a look at how to complete our statement from the drop downs. Budgets facilitate, to start with, well, given what I've just said and what a budget is, budgets facilitate a business to plan. They facilitate planning, and that planning enables a business to do what? Well, given the choice, it's definitely going to be meet the required objectives. All businesses should really need to plan, and they're basically putting those plans in place to try and help the business to achieve what it sets out to do, its objectives. So let's have a look at part B, and what we've got to do in part B, again, we've got a bit of an embedded spreadsheet, not a full-blown version of Excel by any means, but should be familiar to you if you use Excel on a day-to-day basis. And what we've got to do is complete a variance analysis where we're comparing a budget with actual results. And we've got a variance column, and we've got a column to state whether that variance is adverse or favourable, and also a column to show the variance percentage. So we've got a box at the top of the spreadsheet there which gives us some underlying information about prices and costs per hour, labour hours, fixed overheads in total, and also the overall budgeted number of, in this case, service units. We're told that we need to complete the table. We must use formulas in cells B10, B11, D10 and F10, and there's some guidance in the reference panel on accepted format of formulas. The remaining cells we can actually enter the figures. Any adverse variances we're going to show with a minus sign. Monetary values are going to be stated to the nearest whole pound, and the variance percentage column we're told has been pre-formatted to 2 decimal places. Okay, so let's have a look at completing our table then. So remember the cells that need to have formulae put in them. B10, B11, D10 and F10, they've been color coded for us for ease as well. So let's start off with B10. We need to put in the total budgeted revenue. Well, to work out the total budgeted revenue, we need the number of units, which is shown for us in cell B5. And we also need the price per unit, which is shown for us in cell C2. So if we multiply those two together, then we are going to get our budgeted revenue figure. So all I can do is type the formula in. That's all the embedded spreadsheet allows me to do. So I'm going to type in the formula that I would construct if I was using Excel. So I'm going to put in equals, and then I'm basically going to say the contents of cell B5 and the multiplication symbol, I'm going to multiply by the contents of cell C2. Hit return, and I get the answer of 210,000. I can just check it on a calculator, make sure I've got it right in terms of the formula input. 210,000. We can see a little red triangles come up in the corner there. If we hover over that, it actually shows the formula that we've put in. So let's put direct labor in next. So for our budget, what we're going to need to know is the number of hours that are needed, and then multiply that by the cost per hour. That information is provided for us in the panel at the top there. We've got 1,500 labour hours at £25 an hour, so we can pop a formula in to multiply those two figures together. So again, I'm going to keep it simple. I'm going to put in an equals, and I'm going to say the contents of cell B3, and again the multiplication symbol, multiply that by the contents of cell C3, and that gives me 37,500. Okay, so the other cells I need to fill in, I need to put in the variance in cell D10, again with a formula. The variance is simply the difference between the actual result and, in this case, the budget, the comparative figure. And let me just remind myself about the sign on variances, because I need to make sure that any adverse variances use a minus sign. Well, what am I looking at in here in terms of the variance? I'm looking at the revenue. I can see that the actual revenue is less than the budgeted revenue. So that would be, because I'm talking about revenue, an adverse variance. The revenue is not as much as I thought it should be. So I want to show my variance as a negative. So to do that, I simply want to take the contents of cell C10, which is the actual revenue, and I want to deduct the budgeted revenue, which is shown in B10. So just pop that formula in then. So equals C10 minus B10, and that will give me a £3,000 variance. The leading negative tells me that it is indeed an adverse variance. Okay, well, let's just drop down this particular column and calculate the other variances, again being careful about the sign. Remember, we're talking about costs now, because we're talking about direct labour in row 11 and fixed overheads in row 12. So the comparison of the two numbers, so for direct labour I can see that the actual cost, 35,500, is £2,000 lower than the budgeted cost. Now, it's a cost. Is that a good or a bad thing? Well, if I've spent less, then that's got to be a good thing. In terms of I've been more economical, my profit will therefore benefit as a result. So I want to show the £2,000 variance as a positive number. What about the fixed overheads then? Well, I can see that the actual is more than the budget. So I've spent more than I expected. That's not such a good thing. That's an adverse variance. So I want to make sure that that difference of 1,000 is shown with a leading negative. The profit line has already been calculated and input for me, and I can see the variance there is £2,000 adverse. Be careful how you interpret the information then, but just to check, the actual profit, 115,500, is lower than the budgeted profit. Because we're talking about profit, of course, the fact that the actual profit is lower is not a good thing for the business. So it is an adverse variance. Be very careful when establishing the sign of a variance as to whether you're looking at revenue, cost, or profit. So we can now put in, using the drop downs, the adverse or favourable terminology. So for our revenue then, as we said, the actual revenue is lower than budget. It's an adverse variance. For the labour cost is lower than budget. That's a favourable variance. For the fixed overheads, the actual overhead is more than the budgeted overhead because it's a cost. That is adverse. And the profit, the actual profit is lower than the budget because we're looking at profit. That is adverse. Okay, well, in column F, we need to put in our variance percentage. What is the variance as a percentage of the budget, as a percentage of the comparative figure? In cell F10, we need to put in a formula. So basically what I want to do is take the variance figure of 3,000. I want to divide it by the original budget figure of 210,000, and I want to show it as a percentage. I'm going to multiply the answer therefore by 100. So I'm going to put in a simple formula, equals, I'm going to open a bracket because the first thing I want to do is divide the variance into the budget. So I want to divide cell D10 by cell B10. I'm going to close my bracket and then I'm going to multiply the result by 100 and I get minus 1.43%. For the other cells, I can just perform the calculation on my calculator and actually enter the information. So for labour, I'm going to take the £2,000 variance, I'm going to divide it by the £37,500 budget, and I'm going to multiply by 100. So I get 5.33%. And finally, for the fixed overheads, I'm going to take that negative £1,000 variance. I'm going to divide it by the £55,000 budgeted cost, and I'm going to multiply by 100, and I get minus 1.82 if I round it to 2 decimal places. So we've completed our variance analysis using some spreadsheet techniques. Okay, well, the final part of this task then is a true or false task about variances. So let's have a look at the first description. An adverse overhead variance, so we're talking about a cost, could be because office rental costs were negotiated to be cheaper in the year. Well, if we're looking at a cost, the actual cost against the budget, well, basically if we have an adverse cost variance, the actual cost will be higher than the budget. So if we've negotiated a cheaper rent, we would expect the actual cost to be lower, not higher. So basically that statement is false. An adverse overhead variance won't be because office rental costs were negotiated to be cheaper. That would mean we would have a favourable overhead variance. So let's consider our final description then, that a favourable revenue variance, so that means that our actual revenue is higher than our original budget. It could be due to selling more items but at a cheaper price. Well, that could be true in a way, because even though the price has dropped, if we've sold a lot more than is stated in our budget, then the sheer volume could mean that overall revenue is greater. So it is possible that that statement is true.